Silver has gone absolutely vertical, even more than gold has. There is a historic squeeze underway, especially in London, one that started out driven by gold, but has a lot more to do with global conditions as they are turning the wrong direction here in late 2025. So, how far can silver go? What is really driving the silver market? And why does this matter for a lot more than just precious metals? In fact, what are precious metals in this current Eurodollar environment? The answer to a lot of those questions are relatively easy. First of all, silver is being driven by the dollar. However, this is not what everyone says. And yet another example of how what everyone says is wrong about especially monetary mechanics. Over the past several years in particular, precious metals, starting with gold, have performed so much better when the dollar is rising against other currencies, not falling. And this actually makes a lot more sense when you realize how precious metals really fit in the financial system as it exists, not the ones that people want, as it actually exists. They are not dollar substitutes, but they are protection against conditions which arise in the Eurodollar's world. So you combine that with irregularities in silver supply, and the end result is parabolic silver on an increasingly insane short squeeze that has left leasing rates upwards of 30% in London, New York, with some unverified reports having said as much as 100% in some extreme situations. Amidst all this buying frenzy and silver owners finally being able to enjoy some price appreciation, especially relative to gold, there are reasons to be cautious, at least in the short run, even if the fundamentals overall haven't actually changed. And those fundamentals are not debasement and inflation. Quite the contrary. In fact, what we're seeing is exactly a replay of the 2010s when everybody shouted about inflation and debasement, only to find the exact opposite, which is what precious metals were telling us all along. And as of this morning, spot silver was up to $53.88 per ounce at the CME. That's another 1.7% gain on top of yesterday's nearly 3% increase. In just less than a month since the Fed meeting in September, silver has soared by a massive 29%. And already you can see how that feeds into the mainstream myths about why silver is having such a huge run here. The Fed is cutting rates again, which everyone says is akin to money printing, or at the very least, overly accommodative interest rates that are going to further destroy the dollar. If that was the case, then the dollar should have been at zero sometime around the middle of 2011, when instead it went the opposite way from there. Not just in exchange value, also consumer price rates, meaning inflation. The Fed does not really impact the dollar's value either way, and right now the dollar's going higher against most other currencies, even the euro. In fact, unbeknownst to basically everyone in the dollar debasement crowd, foreign interventions to prop up their currencies against the US dollar have exploded here recently, from South Korea to Japan, and especially India. And that's one that we're going to come back to here in this video because it is essential to the silver story. And what we have here is more of these hidden signals that we're talking about in the interest rate market. Alongside interest rates, you've got contango and WTI, but basically all of these financial signals that nobody knows how to decode or what they really mean thanks to central banks' economics and what everyone says when what everyone says is completely wrong. Well, I did a webinar a couple days ago where we went into the hidden truths behind interest rates and some of these other financial market signals. There's a replay of that webinar that's available. There's a link in the description to go there. We also have a very special rate on Eurodollar University subscription, a package that includes everything that Eurodollar University offers, which allows you to decode all of these signals, to go into all of these massive gaps that have been left behind by central banks in economics, and to start understanding the world and how all of these things behave and what they actually mean, instead of trying to rely on the financial media or, God forbid, social media. Like I said, there's a webinar that gets into the hidden world that should not be hidden. It's actually hiding in plain sight. Link in the description. Follow that to watch the webinar, and right to the end, and you'll see the incredible value on Eurodollar University subscriptions. But getting back to silver, the real reason that silver is surging, the simple reason that silver is surging right now is simply because gold is. And as I keep showing you, and I will keep showing you, Gold is being driven by the opposite from inflation and debasement. To begin with, gold has performed terribly when it should have shown the most, at least according to the mainstream myths that everyone just repeats because that's what everyone says. In 2021 and 2022, right when you thought gold was needed the most, when CPI rates were at the worst since the 1970s, nope, gold was doing the opposite yet again. It struggled because, this is the important part, it struggled because precious metals are not inflation hedges. And the reason they aren't is because gold is not a substitute for ledger money, Eurodollars. Gold hasn't been usable money in any kind of volume since the 19th century, and that's not going to change. Demand for gold has nothing to do with monetary debasement or really money anything. Precious metals are instead a store of value, which in the modern age is a separate and distinct property. Bank ledger money, which is now global Eurodollar bank ledger money, these are strictly mediums of exchange. The value of ledger money is completely meaningless. That's not the point. The point is to use them. Ledger money is not meant to be saved. The entire purpose is for the ease of flow and activity, elasticity. Instead, savings, meaning store value, have been handed off to financial assets, especially in the stock market. That's what gold is essentially competing against or is meant to be an alternative to, not dollars. So the driving concern in gold and precious metals is as a competing store of value. And so the more the demand is there for preeminent ones like gold and silver, under the right conditions, gold and silver are going to soar. And once you understand that, you finally see why gold does what it does, and more importantly, when it does what it does, and also when it doesn't do what everyone says it's supposed to do, like in 2021. No one wanted a safe haven store of value in 2021 because it looked like the global system was actually going to recover. Savings poured into risky assets, not haven assets. But as the recovery lie was finally exposed more and more in 2022 with the arrival of Forgot How to Grow, suddenly riskier forms of stores of value were seen as being risky. Now, this didn't stop them from soaring in price too. However, the contradiction with true fundamentals is what drove gold higher, along with assets like US Treasuries and other government bonds. So again, look at how gold performed just in the past year or so. It rose as Forgot How to Grow showed up in more ways and in more places as the US labor market got to be more visibly scarred by it. That's when gold surged. And as I pointed out yesterday, if you have even the last little doubt that maybe gold is reflecting some kind of inflation or dollar debasement, just look at the copper to gold ratio because it buries them forever. Copper to gold is as clear an inflation-deflation signal as you will ever find. And the ratio just today fell to yet another new record low. This one isn't on the fence. It's not sitting in some gray area. It is not ambiguous in any way, shape, or form. At this ridiculous record low, there is no mistaking why precious metals are behaving like this. Deflationary conditions threaten all other risky stores of value. Do you see it yet? The more deflationary the future looks to be, the more people want gold rather than, say, stocks and junk bonds. Or even those people who want stocks and junk bonds start allocating a little bit more to gold. That's why gold was soaring late last year and early this year up until the middle of April. Deflation, bad economics, depression economics, maybe some tariff fears on top. And that's why gold slacked off during the early summer. Following April, it looked like the world maybe had escaped without any real major damage. So stocks surged, there was re-risking everywhere, less of an urgent need for haven stores of value. But once the flat beverage curve really showed up in August, boom! Gold soars, just in time for the dollar to be rising once again. That's the key point that you have to understand. What everyone gets wrong when everyone says gold is inflation or debasement signal. Gold has nothing to do with the dollar, except that it responds to conditions that are signaled by the dollar. And even then, it's exactly backward from what everyone says. This is the problem when no one knows what the Eurodollar is and still believes the Fed is a central bank and currency is something out of a 19th century textbook. Gold is not money. It is not competing with the dollar. It is competing with stocks and junk bonds and other riskier stores of value. Thus, the deflationary signals. When you get into a deflationary period, that's bad for risky assets, good for gold, deflation in the dollar. Now, to understand silver, we we first have to recognize that silver is the cheaper precious metal option for a reason. Gold is king here, and silver in many ways is really just an afterthought. There's a very clear hierarchy in terms of haven. Part of that has to do with silver's use as an industrial commodity, which has been a drag on its price. It's the reason why the gold to silver ratio has been routinely above 80, really going back to 2018 when the Chinese economy fell off. In case you haven't heard, because the media never tells you this part either, China never came back from 2018. And you could plot the gold to silver ratio as it expanded to over 80 and then staying there. You plot that against Chinese GDP, and you can see the regime transfer and transformation in both. And at the same times, silver lags gold more and more because China, and therefore global industry, fell off in 2018, never to return. That's a lot of industrial demand that just vanished, thus again, silver a drag compared to gold. That said, silver is still an alternative precious metal, even if an inferior one. So when gold prices rise enough, silver gets to be a cheap enough alternative to gold, which means demand for gold becomes demand for silver. This is exactly what happened this year. Put gold next to silver and you can see exactly what I'm talking about. Silver started to lag gold when? December 2024. Again, the timing is not an accident. Deflationary conditions all over the Eurodollar and fears on the economic future, both of those propelled gold higher as demand for haven store value, but then they left silver behind because of those macro fears and what those meant for industrial conditions. Silver's industrial use, already a drag on its price, got to be an even greater one, especially relative to gold. Thus, the gold to silver ratio shifted up into the 90s as 2025 began. And that disparity in the ratio went completely nuclear late March and into early April. Gold again soared during that clear deflationary event. Again, not inflation, deflation. As stocks were sinking, silver, like copper, was liquidated because of that deflation. So the gold to silver ratio skyrocketed to over 105, which is a very clear, even crisis deflation level signal. But after April, as gold went sideways, again, as I said, with less acute fears over deflation in the economy, the dollar was even quieting down, not crashing, just coming off its April extremes. So the deflationary macro danger quieted down too, less demand for gold at the margins. But that still left gold very expensive relative to silver. So starting in May, with industry not falling off a cliff, silver started to catch up to gold as the cheaper precious metal alternative. The gold to silver ratio started to come back down on 100 and back into the 90s all over again until we get to August. Once we get into August, as the flat beverage curve made itself known in the US, as well as China, believe it or not, gold suddenly spiked at a 45-degree angle. And that triggered heavy buying in silver too, only silver's supply had been dwindling for years by then, and it finally started to buckle under that golden onslaught. Total silver inventories, especially at places like the LBMA in London, have absolutely crashed over the past couple of years, really going back to 2022. Supply just hasn't kept up, and the more there is demand for the precious metal part of silver, the less the supply side has been able to meet it, so that we got to around August when everything went nuclear in terms of haven demand. It's just this collision between demand and lack of supply and lack of inventory. In fact, LBMA inventories have dropped by roughly a third since the starter forgot how to grow, but even that's not really the true measure of this supply shortage in silver. The free float of silver, or what big banks make available to make the silver market, that has plunged by roughly 3/4, falling to around 200 million ounces from roughly 800 million ounces 6 years ago before the pandemic. There's just not enough silver to go around. And the shortage in London has got to be so acute, the spot spread over New York it got up to a reported $3 an ounce for the first time since the 1980s, back when the Hunt brothers tried to corner the market. The leasing rate has been reported upwards of 30%, with some unverified reports of 100%, annualized anyway, and even higher than that. There are also media reports that silver dealers are purchasing air cargo slots to ship bars across the Atlantic, which is almost always uneconomical. That's how crazy the shortage has gotten to be, and it is driven by the mechanics of gold. Not dollar substitute, not debasement, not inflation, haven store of value competing with risky assets facing deflationary prospects. But with the supply squeeze ongoing, with the lack of available silver either in new supply or in inventories, that has added an extra turbocharged element to demand behind silver that has propelled it even higher than gold, pushing the gold to silver ratio back down to around 80 and actually under 80 in the last couple of days, which suggests that maybe silver's getting a little bit too far ahead of itself because of those technical supply dynamics rather than the underlying fundamentals that continue to propel gold. And we also have to keep in mind, there's been a recent surge from India, traditionally one of the strongest precious metal markets in the world, where higher gold prices really do put bullion further out of reach, therefore really do directly tie into silver. And as demand for silver got to be so strong, one fund in India anyway had to close its purchases because Indian metal funds are required to back their shares with actual metal. And since there's such a huge shortage of physical availability, it's gotten to be too expensive to do so. Massive buying in India, not enough supply to go around. Either way, there's no denying demand coming from India. But why? Again, it's not inflation. After all, India's CPI has tumbled below the Reserve Bank of India's target, nearing an all-time low. Instead, it's the rupee. INR keeps getting pummeled by the Eurodollar, pushing down toward 89 to the US dollar. The Reserve Bank of India has been intervening before yesterday, undertaking a monster currency intervention operation, which temporarily pushed INR back up to around 87.65. But already the rupee is dropping again, back to 88 as of this morning. And we've seen this many times before. These interventions never work because it's the Eurodollar's world. We're all just trying to live in it. That should be your focus, not on all of what everyone says about debasement and the Federal Reserve and all of that stuff. The hidden truth behind all of these monetary signals, including what is happening. Where do precious metals fit in this system? They don't fit what everybody says. So again, even India disproves what everyone says about gold, silver, dollars, and debasement. Gold is supposedly surging because of inflation or dollar doom. Yet in India, anyway, the dollar is doing the opposite. It's the rupee that's getting crushed, and it is not creating consumer price inflation. Quite the opposite there, too. It's the rupee that's getting crushed. And why? Because Eurodollar tightness is driving the dollar higher against it, and other currencies along with it. Do you see it yet? Deflationary conditions are pushing the US dollar exchange value higher, and those conditions are why the demand for haven is rising, not as a replacement for the dollar, as a safer substitute store of value for risky assets like stocks and junk financials that do not perform well under the full consequences of deflationary conditions that are projected by a rising dollar and a rising gold and silver price that go along with it. Now, all that said, there are reasons to be very cautious on buying both gold and silver, at least in the short run. To start with, Indian buying is very seasonal. In fact, this burst of demand from the subcontinent not coincidentally coincides with India's festive season. You take away some of that seasonal demand, maybe all that seasonal demand, and the supply squeeze starts to normalize, and then we know what happens after then. Supply squeezes always follow the same pattern. The price goes parabolic, and then it crashes. We've seen it a couple of times in copper, including just a couple months ago. And if the inevitable short-run reversal in silver does get to be bad enough, it does start to crash like copper did, there is the very real chance, paradoxically, it spills over into gold. So where gold is yanking silver up to this demand squeeze, silver turning around and falling hard might actually dent demand for gold, at least again in the short run, especially since gold's rally is itself getting to be a little bit much on its own terms. So silver is set up for a supply squeeze correction, and one is also due for bullion. But that's just the short run. One more time. Precious metals are not dollar substitute. It's not debasement. It's not inflation. It is the consequences of a rising probability for deflationary conditions in the monetary system, the real monetary system, as well as the overall economy, which is bad news for riskier types of other stores of value. So gold is rising as an alternative to those that do so poorly in the full deflationary conditions. Think earlier this year, only potentially bigger as the cockroaches are starting to scurry around. The more signals there are confirming deflationary potential, including a rising dollar exchange value, the more demand there will be for gold. And as gold goes higher and higher, it gets more and more expensive. Demand for silver as a cheaper precious metal alternative necessarily rises too. And with silver supply dwindling for years, it led to the perfect storm of supply squeeze price explosion. Realize it's deflation and tight money that are behind everything here, not inflation, not debasement. But that's actually good news if you already own precious metals, even if in the short run it might get a little bit dicey because of the supply squeeze dynamic. But longer term, the fundamentals that are driving precious metals, while good for precious metal owners, not good for everyone else. And there was another key critical warning that was tripped this week that goes right alongside gold and silver, the real gold and silver story. Went over that in the video link below. As always, thank you very much for joining me. Check out our webinar and our Eurodollar University deal. There's a link in the description for that. Huge thanks to Eurodollar University members and subscribers, especially all you new ones. And until next time, take care.